Let's get a move on and focus in on earnings. The management of IDBI Bank here to discuss how the company has posted the first annual profit in the last 5 years. What is the outlook on their GNPA ratio, their CASA and credit growth? Rakesh Sharma, the Managing Director and CEO, is here to walk us through just that. Thank you so much for taking time out, Mr. Sharma. Definitely a memorable quarter and year for you as your bank is back in the black for FY21. And you've exited the PCA framework as well. So what's the outlook for IDBI Bank? Can we expect that this trajectory will continue? There will be no losses going ahead. What kind of profit growth are you penciling in?
Yeah, thank you. Thank you very much and good morning. So, based on the transformation strategy which we had taken over the last 2.5 years, so we have been able to attend to all the issues. And the cleaning process is, I will say, it is over. And yes, certainly, because now we have reached a stage that we will be able to sustain this profit. Rather, we will be able to improve upon the performance. So this year, like my net profit, and that ROA was 0.46. And my expectation and guidance for the next year is that we will be able to achieve the ROA of 0.65 to 0.70. So as far as, the overall position, basically you would have seen that the COVID had affected this entire financial year because the last time the first lockdown was declared on 24th March. So there were a lot of uncertainties attached. But we were able to attend to all the issues, of course, thanks to RBI and Government of India who had announced various relief measures. So based on that, you would see that, these slippages are quite under control. We had, I had in my last interview indicated to you that we will be able to keep the slippages below 2%, and it is 1.91%. So it has gone as per our expectations, and in future also I am sure that we will be further improving upon the performance.
Okay, we're also seeing that your Q4 GNPAs are lower than the pro forma GNPA. What led to this performance and what have been your slippages and recoveries for FY21?
Yeah, like as I mentioned, these slippages, basically we were able to contain these slippages. That whatever, because you see that first quarter, second quarter, third quarter, because that moratorium was there, then the Supreme Court stay was there. So we had not announced the NPA. So it was, there was a fear that the entire NPS will be accumulated during this current quarter. But yes, some because the slippages which have happened for the current quarter, it was around 2,382 crore. So which is again, as I said, less than 2%. But this is for the entire year that we have to keep in mind. So because this first 3 quarters we had not declared the NPAs. So this number one, the slippages we have been able to keep under control. Number two, despite the fact that COVID situation was there, NCLT, the hearings were getting delayed. There were rather virtual hearings were there. So we were able to make some good recoveries. In fact, the total recoveries I had indicated to you during the last interview that our total overall recoveries will be between the range of 4,500 to 5,000 crore for the full year. But I am happy to tell you that, the total recoveries have been, including recovery from write-off, around 6,027 crore. So recoveries have been good. Not that we have written off. We have not written off many advances. So, and then we were able to upgrade one big account also. So that was around 700 crore. So all those things which has helped us in, reducing our GNP also and net NPA, because we have been quite aggressive in making proactive provisions that RBI also wants that. And this year, this quarter also, we have made accelerated provision. So this pro forma NPA, net NPA was 2.75. As against that, now my net NPA is 1.97, which is quite a good improvement. So that way, I hope we will be able to sustain this position in the coming quarters and the next year also. But yes, I will like to mention that because of this further uncertainties with the COVID wave 2 coming, so there are uncertainties, there are some worries, but at the same time, we are cautious as such, we are cautious, but at the same time, not that I'm not expect any major, reverse surprises. So things will be under control. That is my position for at least for my bank.
Sure. Mr. Sharma, what outlook can you give me on recoveries as well as provision write back for FY22?
Now this, because still, as I said, there are uncertainties, but still what I feel is the recoveries which we have assessed account, because we do assessment account by account. So we have expected the total recoveries of around 4,000 crore during the current year 2021-22. And as you know that, my provision coverage ratio is 97%, 96.9. So almost everything has been provided. And these recoveries mainly will be coming from the large accounts. So that way that, whatever it comes, either if it is from the return of accounts, it will go to profit. But if it is from the gross NPA with the accounts which have not been written off, so it will go for reversal of provisions. So, whatever recoveries we make, so almost more than approximately 90% will go towards the provision reversal. So that is what, the hidden profit we have in our books now. So, so that is that will help us in further improving the position.
Going forward, then give us a sense, Mr. Sharma, as to what the outlook is for the industry as well. Do you see private players, foreign investors, PEs interested in picking up a stake, and what do you think needs to change in order to attract long-term private investment in banks?
I'm sorry, actually, the voice was quite feeble in the beginning. Can you please repeat your question? I think maybe I'll request you to speak little louder.
Sharma, I'm talking about for the industry. Are you seeing private players, foreign investors, or PEs interested in picking up stake in banks? What do you think needs to change in order to attract this kind of long-term private investment in banks?
Actually, your voice is breaking, but if little bit I could, join the things and question, maybe I like to attempt the answer, although I could not hear properly. So that, basically, maybe you are asking about the government divestment of stake. So that in any case that, DIPAM will be taking up the process, this process. And of course, now since the bank has been able to improve the performance, last all issues have been attended to, and there is now upward trajectory is expected. So of course, I feel that, there will be some investors who will be interested in taking up the investment. But of course, I'll not be able to comment much on that. But as one more thing, I think the outlook for the industry you had asked. Yes, certainly, this because of this COVID situation, the uncertainties are there. But one thing is there, this last year we have seen wave 1, and we have with the various release measures announced by government and RBI, we were able to come out of that situation. Now also the vaccine has also come. There are positive features. We have understood the issues. Government is taking various other actions. So hopefully the things will be under control soon, and then the things will start looking up better. Some of the manufacturing companies are really doing well, like steel, cement, and other units. So things will start picking up. Maybe once this present situation within 1 or 2 months, once it is brought under control, now vaccine has also been opened up. So things will start looking up.
What can you tell us about the loan book growth for FY22, Mr. Sharma?
Yeah, in fact, because so far, really, we were doing, consolidating our balance sheet. So the growth was not there. But now, since 2 things, one, we are out of PCA. Number 2, our capital adequacy ratio is quite comfortable, 15.59%. Our all policies are in place. So, of course, we will grow in a very calibrated manner. The things which we have learned from our past experiences, we will not be repeating. But yes, certainly our focus will be on mid-corporate, more in corporate advances with manufacturing activities and some good concern, high rated company. So with that, my expectation is that in SRA, means our retail assets, we will be growing by 10 to 12% because now this year COVID situation is still uncertainties are there. So I am not projecting very high growth, 10 to 12% in retail assets, and in corporate 8 to 10%. Overall 10% growth I am expecting. My liquidity position is quite comfortable, capital is comfortable. So this around 10% growth will not be a problem at all. So with that, that will help us in our improving our revenue. What was happening so far, although with our reduction in cost of deposit, you see my CASA deposits have reached above 50%, which is a good benchmark. So with that cost of reduction and controlling my, both assets and liability side, we were able to improve upon the net interest income. So focus was on improving the NII. But overall total revenue, there was, yes, reduction, I will agree, because there was no growth in advances. Now, once we start growing up in advances, so we will be able to show improvement in our revenue, overall total revenue also, and expenses are under control. So with that, that will give me better net interest margin, and that will help me in improving the profitability. So that will be the, plan of things for the bank. And otherwise, all good risk policies are in place. So hopefully, as I said in the beginning, we are out of problem, and now there has to be some upward trajectory has to be there, and we will try for that.
Do you have sufficient growth capital, or would you need to raise funds in FY22?
Now, like, my the capital adequacy ratio at 15.59%. So what I have indicated that the minimum regulatory requirement is 11.5, but still we will try that we will not come below 13.5. So 13.5 and 15.59. So still, with that capital only, we will be able to grow more than 12 to 13%. And whereas I am targeting growth of 10%. So there is sufficient growth capital available. And you see, presently, my Tier 1 capital is 0. Means Tier 1 means that Tier 1, these bonds are 0. The entire Tier 1 capital is in the form of CET. So the entire CET is there. So we have, opportunity to raise Tier 1 bonds also at, at the appropriate time whenever we need these funds. Then similarly, Tier 2 also it is around 2.5. So there also we can raise. And then more than that, I'll be depending on my internal generations. Like as I said, the provision coverage ratio is more than 95%. And whatever recoveries we make, that will help us in improving, the reversal of provisions. So the internal accruals will be there. So that will also help. So further, this year, at least, we don't need any capital. Because this is sufficient for the growth which we are envisaging. But at the same time, yes, we are open at any time, if need be, and at the appropriate time, if we feel, there is a appetite in the market, we will certainly be open and raise capital.
Mr. Sharma, great to have you on the show. Thank you so much for taking the time out and joining in today. On that note, we're going to take a very quick break, come right back. Lots more lined up on the other side.